Welcome to Finstride, your one-stop shop for discovering the secrets of savvy investment. The road to wealth development might be difficult in today's fast-paced financial environment. But don't worry, we're here to help you on your way to financial prosperity through passive index fund investment. Join us in our video as we unpack the mystery of passive index fund investing, giving you the information and tools you need to safeguard your financial future. But before we begin, don't forget to subscribe so you don't miss out on any of our useful insights. Finstride is the first step in your financial journey. First of all, let's see what is passive index fund. A passive index fund is a type of mutual fund or exchange-traded fund, ETF, that follows the performance of a certain market index, such as the S&P 500 or the Dow Jones Industrial Average. This indicates that the fund's performance is intended to reflect that of the index it is tracking. Also, it is a type of passive investment in that they do not attempt to outperform the market. Instead, they merely seek to replicate the performance of the market. In contrast, active investing entails attempting to select individual companies or mutual funds that will beat the market. Why should you invest in passive index funds? Passive index funds have grown in popularity among investors in recent years, and this spike may be ascribed to a variety of convincing factors. The most notable of these benefits is their exceptional cost efficiency. Passive index funds often have lower cost-to-income ratios than actively managed alternatives. This cost discrepancy is partly due to the lack of the requirement for large teams of financial analysts or specialists to handpick individual stocks or make complicated market timing choices. Passive index fund management is based on the simple premise of tracking and replicating the performance of a certain market index, such as the S&P 500. This simple solution drastically cuts operational costs. In contrast to actively managed funds, which need continual research, analysis, and decision-making, passive index funds necessitate less continuing interaction. As a result, management fees and related expenses are significantly reduced, allowing investors to keep a larger share of their gains. Furthermore, the low cost of passive index funds corresponds to the larger trend of fee-conscious investment. Investors are increasingly lured to the concept of avoiding expenditures that might eat into their profits over time in an era when every basis point matters. Passive index funds provide the dual benefits of cheaper expenses and the potential to beat many actively managed funds over the long run due to their ability to track the market's overall performance. Furthermore, passive index funds have shown a consistent capacity to generate high long-term performance. This track record of achievement is a major contributor to their appeal. Passive index funds have beaten the vast majority of actively managed funds across long investment horizons. The inherent difficulties associated with active management are to blame for this outperformance. Due to a variety of issues, including expensive fees, emotional biases, and the difficulty of making accurate forecasts about market movements, actively managed funds frequently struggle to consistently outperform the market. Passive index funds, on the other hand, seek to duplicate the performance of a given index, allowing investors to enjoy the broader market's gains over time, but avoiding the risk of surpassing it. Another compelling reason why investors choose passive index funds is diversification. When you invest in a passive index fund, you are effectively purchasing a share in a diversified portfolio of companies that reflect a certain market section or the whole market. This diversification distributes your risk across a wide range of assets, lessening the impact of individual stock volatility. As a consequence, your investment is less vulnerable to swings in any particular company's performance. Diversification is a key element of risk management in investing, and passive index funds make it simple for investors to achieve it without the need for considerable research and company selection. Furthermore, passive index funds are simple and easy to use. Investors are not required to continually monitor their portfolios or make trading choices regularly. Instead, individuals can use a buy and hold approach to let their investments grow over time without the hassle of active management. Individuals with a lengthy investing horizon who prefer a hands-off approach to wealth management would find this method particularly appealing. Passive index funds are popular owing to their low costs, long-term performance, and diversity. They are crucial in investing plans because they provide a simple approach to engaging in financial markets while minimizing expenses and risks. These funds, whether seasoned or novice, give wide market exposure, making them a dependable and hassle-free investment solution. Investing in passive index funds is a popular and simple method for those wishing to accumulate money gradually. These funds provide a variety of investing options that combine flexibility and convenience of use. When considering the purchase of a passive index fund, several critical aspects must be considered. The fund's past performance, expense ratio, tracking error, and the exact index it seeks to mirror are among these considerations. When making this option, one should also examine their investing goals, risk tolerance, and time horizon. Investors may make educated decisions that match with their financial objectives and set the road for long-term financial progress by carefully examining these components. A brokerage account is the first way to invest in passive index funds. Brokerage accounts provide a variety of investing possibilities, including access to a large number of index funds. This strategy enables investors to actively manage their portfolios, analyze performance, and make adjustments as appropriate. Another popular option is to invest in employer-sponsored retirement plans, such as a 401k or an individual retirement account or IRA. Many firms include index funds in their 401k plans, giving employees a tax-advantaged method to invest for retirement. Traditional and Roth IRAs both provide access to index funds, allowing individuals to increase their retirement assets at their own pace. Robo-advisors are a contemporary and handy approach to investing in passive index funds. These automated investing platforms employ algorithms to construct and manage diverse portfolios of index funds depending on an investor's financial objectives and risk tolerance. Robo-advisors manage all elements of investment, making them an excellent choice for people who want a hands-off approach to investing. Investors must examine many important considerations when selecting a passive index fund. First and foremost, choosing a market index that corresponds to your investing objectives is critical. Market indexes can encompass the U.S. stock market, worldwide markets, bonds, and other assets. The index you choose should represent your risk tolerance, investment horizon, and financial goals. Second, expense ratios are critical in fund selection. One of the key advantages of passive index funds versus actively managed funds is their low costs. It is critical to examine the expense ratio of the fund, since even a little percentage change might have a major influence on your returns over time. Choosing a fund with low fees helps you to keep a larger share of your investment profits. Finally, assess the fund's liquidity. The ease with which you may acquire and sell fund shares is referred to as liquidity. Most passive index funds are very liquid, which means you may trade them rapidly and with little price effect. It is important to note, however, that certain less popular or specialized index funds may have lesser liquidity, potentially leading to greater bid-ask spreads. In conclusion, investing in passive index funds is a straightforward and successful long-term investment strategy that minimizes risk, diversifies your portfolio, and saves money on fees. Begin small, since even a modest amount may increase over time. Rebalance your portfolio regularly to ensure it fulfills your investing objectives, selling wins and purchasing losers. Don't sell in a panic if the stock market falls, since it has always trended higher in the long run. Investing in passive index funds involves patience and discipline, but with these funds, you may reach your investing goals. It's a long-term approach that can be accomplished with patience and discipline as the stock market continues to rise. Thank you for watching in to hear about the benefits of investing in passive index funds. If you found this video useful, please like, comment, share, and subscribe to remain up to speed on financial knowledge. See you in the next video.